Before we get into details, let's start with the foundation. What exactly is investing and why is it so important? At its simplest, investing simply means using your money to create more money. That's really all it is. But why does that matter? Why should your money be working for you instead of just sitting there? The first reason is inflation. Over time, inflation quietly reduces the value of your cash. Prices go up, but the money sitting in your account stays the same. So if you have $1,000 today, a few years from now, the same amount may only buy you what $800 can buy you today. Doing nothing may feel safe, but the reality is it is one of the slowest ways to lose money. The second reason investing matters is that it's one of the most reliable ways to build wealth. We live in an economy that rewards ownership on assets like businesses, real estate, and stock, far more than simply earning a salary. Think about it. Someone who bought properties 20 years ago has likely seen its value more than doubled. Someone who invested consistently in the stock market would have earned around 8 to 10% per year on average over the long term. Meanwhile, salary has struggled to keep pace with inflation. So if you ever feel stuck in a circle of earning, spending, and starting over again, investing is one of the tools to help you break out of that loop. It allows your money to grow alongside you instead of falling behind. In this video, I'll walk you through how investing works, especially if you're a beginner. Now that we understand why investing matters, let's talk about how the stock market actually works. When you buy a stock, you're buying a small ownership stake in a company. If you buy 1 share of a company, maybe Netflix, you're owning a tiny piece of that business. What you're really saying is, I believe that this company will continue to grow, continue to make money, and become valuable over time, and I want to benefit from that growth. Once the company offers its shares to the public, those shares are traded on the stock market. The stock market is simply a marketplace where people buy and sell ownerships in thousands. Prices move up and down all day based on what investors believe those companies are worth. Now, there are 2 main ways investors make money from stocks. The first is price growth. If you buy a stock at $100 and later sell it at $150, the difference is your profit. That gain is called capital gain. The second way is through dividends. Some companies pay part of the profit directly to shareholders, usually a few months or once a year. It's a way of rewarding investors for owning the stock and encouraging them to stay invested. At this point, you may be wondering, so which stocks should I buy? Well, you could invest in individual companies like MTN, Netflix, or Apple. Although investing in individual companies comes with more risk. Even top companies can struggle or fall out of favor. Take BlackBerry for instance. In 2008, BlackBerry was everywhere. If you had invested $140 in 1 share back then, it would be worth only a few dollars today. Very few people predicted how quickly smartphones and messaging apps would evolve. Even professional investors find it incredibly difficult to consistently pick winning companies. That is why many successful investors don't try to guess which company will win. Instead, they simply invest in something called index funds. An index fund is a collection of hundreds or even thousands of companies bundled together. Rather than betting on one business, you can invest in an entire market. For example, the S&P 500 tracks the 500 largest companies in the United States. Over the long term, it has delivered strong returns by simply capturing overall economic growth. By investing in an index fund, you reduce risk, spread money across many industries, and benefit from the general upward trend of the market, even when some companies do fail. Now that we know what investing is and what to invest in, let's talk about how to get started. This is the app or website used to buy and manage investments. Make sure it's regulated, trustworthy, and has low fees, because those fees, even small ones, can seriously reduce your returns over time. Next, you want to look at the type of accounts available. Some accounts are taxable, while others offer tax advantages, depending on your country. If you have access to a workplace pension or employer investment plans, that's one of the best places to start. After choosing the platform, the next thing you want to do is go ahead and fund your account. You can usually do this through a bank transfer or using a debit card. It's that simple. Now, the next thing you want to do is choose your investment. As a beginner, diversified funds are usually safer and more effective than picking individual stocks. You can start broad and refine your strategy as you go. When I started, I used to use a fund manager, Kara, to manage my funds, but now I do it myself. They were able to help me pick my strategy and diversify. But if you're starting as a beginner, I suggest you go diversify and eventually refine your strategy as you gain experience. The next thing you want to do is automate everything. Instead of trying to time the market, set up automatic monthly investments. This strategy is known as dollar cost averaging. It helps smooth out the market up and down and removes emotional decision making. Now the common fear is, what if the market crashes? The truth is, market goes up and down all the time. It's completely normal. But if you're diversified across funds and assets, you're far more protected than you think. Ironically, the biggest risk for most investors isn't the market, it's their own behavior. Panic selling during downtowns or waiting forever for the perfect time to invest. This causes more damage than the market itself. Automating your process helps prevent you from making emotional mistakes and keep your long-term plan on track. So if you're thinking about investing but don't know where to begin, I hope this video helps simplify things and give you the confidence to take the first step. Thank you so much for watching. If you enjoyed this video, please give me a like, subscribe to my channel. If you have any questions, just drop it in the comment section and I'll be sure to get to it. Thank you for watching and I'll see you in my next video.